I want to ask you something that has probably been sitting in the back of your mind for weeks. You did the research. You followed the logic. You watched the geopolitical signals align exactly the way serious investors look for. You bought gold. You bought silver. And now you are sitting there staring at your portfolio, and it is red, not slightly red, meaningfully, painfully red, down double digits on your gold position, down close to 50% from January highs in silver. And here is what makes it feel almost cruel. The central banks are still buying gold at historically unprecedented rates. The national debt just crossed $39 trillion. Bombs are still falling across the Middle East. Every single condition that is supposed to drive precious metals higher is firmly in place, and yet your position is still bleeding. So I want to ask you directly, do you actually understand why that is happening? Not the headline version, not the surface level explanation, the actual mechanical sequence operating beneath it. Because if you do not, you will make the wrong decision at exactly the wrong moment. And that moment is closer than most people currently realize. What I'm going to show you today is not an opinion or a hope. It is a repeating pattern, mechanical, structural, and documented, that has played out after every major oil shock since 1973, without a single exception. Once you see it clearly, you cannot unsee it. And when you understand what always comes after the phase we are currently in, you will understand why I chose the word unthinkable. Start here, because until you understand the mechanism, nothing else I'm going to tell you will fully land. The most common question serious gold investors are asking right now sounds like this: why is gold falling when everything that should make it rise is happening simultaneously? And the answer is not complicated once you strip away the noise. It is a mechanical chain reaction, and it starts with oil. When a major geopolitical event disrupts oil supply, whether that is an embargo, a revolution, or a conflict that closes a critical shipping route, crude prices spike rapidly. That spike does something immediate and powerful to financial markets. It does not just raise energy costs, it raises inflation expectations, not actual inflation yet, but the anticipation of it. And in financial markets, expectation moves as fast as reality. Traders price in tomorrow's inflation today. Now here is where it gets counterintuitive. When inflation expectations rise, the Federal Reserve loses its ability to cut interest rates. The one policy tool the market was hoping for, rate relief, gets taken completely off the table. Fed funds futures immediately reprice. Suddenly, the bond market tells a new story. The 10-year Treasury yield, instead of falling, stays elevated or rises further. And that creates the critical problem for gold. A 10-year Treasury bond paying 4% or more with zero credit risk, zero volatility, and zero storage cost becomes a genuinely attractive alternative to holding an asset that pays nothing. Institutional portfolio managers, the ones managing billions on behalf of pension funds, endowments, and sovereign wealth vehicles, do the math. Some of them rotate capital out of gold and into government bonds. That selling pressure hits gold from one side. Then simultaneously, global investors seeking safety in a crisis buy U.S. Treasury securities. That demand for dollar-denominated assets drives the dollar index higher. And because gold is priced in dollars, a stronger dollar mechanically suppresses the dollar price of gold. Fewer dollars are needed to purchase an ounce when each dollar is worth more. So you have three headwinds hitting gold simultaneously: institutional rotation out, dollar strengthening, and the Fed frozen on rates. And all three are caused by the exact same oil shock that should, by every conventional understanding, be making gold go up. This is the mechanism. This is why your portfolio is red while the world burns. And this is why gold has always been red, at least temporarily, during every major oil shock in the last 50 years. But here is where the story changes completely. Because this mechanical suppression has never been permanent, not once in 5 decades. I want to show you the record, not because past performance guarantees anything, I'm not making that argument, but because when the same pattern repeats after every single major crisis across 50 years of data, ignoring it is not prudence. It is the most expensive form of denial available to an investor. Start with 1973. OPEC cuts production and slaps an embargo on the United States. Oil quadruples in price almost overnight. Gold initially drops as the mechanism I described takes hold. And then, over the following 2 years, gold rises 150%. Zoom out to the full arc of that inflation era, from 1971, when Nixon ended the gold standard, through 1980, and gold rose 2,300%. That is not a typo. Move to 1979. The Iranian Revolution collapses oil production. Prices reach levels that seemed impossible just months earlier. Gold sits still initially. Then, over the following 12 months, it rises 89%. Then another 10% the year after that. Then the Gulf War. Iraq invades Kuwait. Oil spikes. Gold pops roughly 10% in weeks before pulling back. But the structural case quietly strengthens beneath the surface. Then September 2001. Markets crash in one of the most psychologically devastating events in modern financial history. And then gold begins a decade-long bull run from $250 an ounce all the way to $1,900, a 660% move sustained over 10 years. And then 2022, Russia invades Ukraine. Gold breaks through $2,000 per ounce for the first time, setting new all-time highs while the world watches in disbelief. Every single time, a major oil shock, a period of mechanical suppression, and then a recovery that produces gains that reshape the portfolios of those who had the patience to stay. The mechanism that temporarily suppresses gold eventually reverses, and when it does, it reverses all at once. 3 headwinds become 3 tailwinds simultaneously. The structural case for gold, which never actually disappeared, reasserts itself with the full force of every driver that was building quietly beneath the surface. That is not coincidence. That is not luck. That is the same mechanical sequence running in reverse. Now, here is what you need to understand about this specific moment, because the pattern is consistent, yes. But the structural conditions underneath this cycle are not the same as any previous cycle. They are categorically more extreme in every meaningful dimension. In 1973, the United States national debt was approximately $500 billion. Today, it stands at $39 trillion. That is not simply a larger number. That is a fundamentally different fiscal reality, one that changes what the Federal Reserve is actually capable of doing in response to inflation. In 1973, Paul Volcker eventually raised interest rates to 20% to break the inflationary spiral the oil shock created. That response was brutal. It caused a severe recession, but it worked. Today, the Federal Reserve is paying over $1 trillion annually just in interest on existing debt. Raising rates to 20% would not break inflation. It would break the government's ability to function. The arithmetic does not permit the same solution, which means the inflationary pressure from this oil shock has no clean exit path. In 1973, central banks were selling gold. Today, central banks are expected to purchase approximately 755 tons of gold in 2026 alone, more than double the historical average from before 2022. 3 consecutive years of purchases above 1,000 tons, followed by continued elevated buying. That is not portfolio diversification. That is strategic repositioning at a scale the gold market has never before absorbed. In 1973, there was no structural silver supply deficit. Today, we are entering the 5th consecutive year in which industrial consumption of silver has exceeded mine supply. 5 years of demand outpacing production, 5 years of inventory drawdown with no supply response coming, because most silver is mined as a byproduct of other metals, meaning producers cannot simply decide to make more of it because the price rises. And the industrial demand driving that deficit, solar panels, electric vehicles, artificial intelligence infrastructure, defense electronics, semiconductors, is not price sensitive at current silver price levels and cannot readily substitute other materials without significant performance degradation. Every structural driver present in 2026 is more powerful than its equivalent in any previous cycle. More debt, more central bank buying, deeper supply deficits, greater industrial dependency, and a Federal Reserve with far less room to respond. The same fire, a much bigger, far more combustible room. Let me give you something practical now, something you can actually use to position yourself correctly, not just emotionally, but strategically. because understanding the historical pattern matters. But knowing exactly where you are inside that pattern is what separates the investors who build wealth from the ones who watch it happen from the sidelines. Every major oil shock I have studied follows the same four-phase recovery sequence. Phase 1 is the panic phase. This typically covers the first 1 to 4 weeks after the initial geopolitical event. Oil spikes dramatically. Gold spikes initially on the first wave of fear buying, then drops hard as the mechanical sequence takes hold. Financial media enters full crisis mode. Red graphics, constantly updating headlines, commentary designed to maximize anxiety at every hour of the day. In Phase 1, most retail investors do one of two things. They panic sell at the bottom of the initial drop, locking in permanent losses at the worst possible moment. Or they panic buy gold at the absolute top of the initial spike, chasing the fear trade right as institutions are quietly beginning to exit. Both decisions are typically expensive. While retail is running for the exits or chasing the spike, institutional investors are doing something entirely different. They are watching patiently. They have seen this movie before, and they know what comes next. Phase 2 is the absorption phase. This typically runs from month 2 through month 3. The initial panic subsides slightly. The fear index comes off its peak. Gold pulls back from its initial spike, sometimes significantly. Silver falls harder, often 15 to 20% or more from recent highs. And this is where the most expensive decisions get made. Investors look at their portfolios, see continued red, read a headline declaring that gold has failed as a safe haven, and they sell. In my experience, watching markets through every major crisis of the last 4 decades, Phase 2 is almost always the bottom, and selling at the bottom is precisely how investors lock in permanent losses instead of participating in the recovery that follows. Phase 3 is the structural bid phase, typically running from month 4 through month 18. The panic-driven institutional selling that suppressed gold in phases 1 and 2 exhausts itself completely. The structural buyers, central banks, long-term institutional allocators, physical gold buyers across Asia begin accumulating steadily at current price levels. Gold finds a genuine bid again, not a panic bid, but a slow, patient, structural one backed by forces that do not disappear when the news cycle moves on. Miners begin leveraging their improving margins. And most retail investors are sitting on the sidelines, having sold in Phase 2, watching gold make new highs and telling themselves they will wait for a pullback. In many cases, that pullback never arrives. Phase 4 is new all-time highs, typically from month 12 onward, sometimes extending 2 to 3 years. Based on the timeline of the current crisis and the price action I am observing right now, I believe we are sitting at the transition between Phase 2 and Phase 3. The forced institutional liquidation has largely exhausted itself. The structural buyers are beginning to accumulate. The question is not whether Phase 3 is coming. The question is whether you will be positioned when it arrives. I want to spend a moment specifically on silver, because silver's story in this cycle is different from gold's in a way that most investors do not fully appreciate. Gold is a monetary metal. Its price responds primarily to sovereign buying, currency debasement fears, and institutional safe haven demand. Silver is all of that, and it is also something else entirely. It is an industrial metal with a demand base that is growing faster than at any other point in its recorded history. This dual nature creates a characteristic pattern. Silver tends to lag gold on the initial breakout. In the panic phase and the absorption phase, silver falls harder and faster than gold. It looks broken. It looks like the weaker asset. And then when the monetary bid returns in Phase 3, the industrial demand that has been running continuously throughout the entire crisis period adds to it rather than competing with it. Two engines firing simultaneously. That combination is what produces silver's historic tendency to not just follow gold in the recovery, but to dramatically overtake it. In the 1979 cycle, gold rose approximately 276% from the Iranian Revolution to its 1980 peak. Silver rose from roughly $5 to $50, a tenfold increase, outperforming gold by a factor of 3. In 2026, the industrial demand base underpinning silver is more powerful than in any previous cycle. Every solar panel manufactured requires silver as a conductor. Every electric vehicle uses 60 to 80 grams of silver, compared to 15 to 20 grams in a conventional car. Artificial intelligence data centers, defense electronics, satellite communications, advanced semiconductors, all of them require silver, and none of them can substitute another material without meaningful performance loss. Layer on top of that a fifth consecutive year of supply deficit with no supply response structurally possible in the short term, and the fact that China controls approximately 60% of global silver refining capacity and has restricted exports as a strategic material. Silver's lag right now is not a weakness. It is a loading mechanism. The spring is being compressed, and when it releases, history says it releases with significantly more force than gold. Let me close with what actually matters, the two numbers to watch and the one decision now in front of you. Forget the daily oil headlines. Forget the geopolitical news cycle. Financial media is not going to signal when the mechanical suppression is exhausting itself. Two indicators will. The first is the US dollar index. When it falls back below approximately 97, the primary mechanical headwind on gold's dollar price begins to diminish meaningfully. This will happen when oil stabilizes and alternative supply routes absorb enough of the current disruption to reduce the emergency dollar demand the shock created. The second is the 10-year Treasury yield. When it falls back below 3.5%, the opportunity cost argument against holding gold collapses. Institutional capital that rotated into bonds during the suppression phase begins rotating back into real assets. Both of these reversals will come when the Federal Reserve begins cutting rates, and the Fed will begin cutting when the arithmetic of $39 trillion in debt at 4 to 5% interest becomes a greater systemic threat than the inflation they are trying to contain. Watch the dollar, watch the yield, everything else is noise. Wells Fargo has lifted its year-end 2026 gold target to $6,100 to $6,300 per ounce. J.P. Morgan forecasts $6,300 by year-end. UBS has raised its target to $6,200 by September. These are not retail investor wishes. These are the research departments of institutions that manage more capital than any other entities on Earth. They are not issuing these targets because they believe the current suppression is permanent. They believe, as the structural analysis demands, that it is temporary. There are two types of investors watching this unfold right now. The first sees red and concludes the trade is finished. The second sees the same red and thinks, phase 2, mechanical suppression, structural setup more powerful than at the top. One of those investors will build wealth from what comes next. The other will watch it happen from the sidelines and say they always knew they should have held. The unthinkable is not something that has never happened before. It has happened after every major oil shock in 50 years. What makes it unthinkable this time is the scale of what is underneath it. Watch the dollar, watch the yield, be patient.